the amendments which are carried out in two Finance Act, I would say. Finance Act 21, definitely because of the assessment year 22-23, as they are going to be applicable for our filing the return of income. And as the topic also talks about amendments applicable for assessment year 22-23. So it's the Finance Act 21 which we normally start referring to. But in last, you can say 3-4 years particularly, you will observe, it doesn't stop over there. It's the Finance Act 22 also, which is very crucial. And this year is also no exception to it. We have many provisions. We will see that to a greater extent, they have been made applicable to assessment year 22-23. And while computing our return of income, while preparing our return, we have to take care of those amendments which have been carried out. And wherever need be, a specific observation will be made by our speaker, and wherever required, I will just bump into it and say that yes, this has been applicable from this return filing income. Therefore, we have to be more careful while preparing our computation of income. Certain issues which are otherwise we were blindly referring to or saying ki haan, as per old law hai, but that would not be applicable. Say for example, if I have to give it section 14A, we used to say that, okay, there is no exempt income covered by many case laws. 14A would not apply to me. That is not the case anymore. We have now amendment to this, which we will have to be careful about. And the best one is the updated return. Abhitan has slide, and he would be covering this updated returns, how to make our return updated on the returns which have been filed or which have been remained to be filed. He will cover up those areas, plus certain expenses which otherwise we were treating it as our business expenses, the freebies given more particularly by the pharma companies, the education cess and the surcharge which were claimed as a business expenditure and not disallowed in the computation of income. Those all stands to be understood and taken care of while preparing our computation of income. And I'm sure Abhitan would be touching upon certain important aspects of the ITR where the disclosure or what is required. So in his slides, he even have that. So before we would end, even those amendments or those disclosures which are required would also be covered. With this, not taking any much time, I would straight away request Abhitan to please start with his slide presentation. Thank you.
Thank you, Sharma ji. Thank you, Mahendra bhai. It's an honor and a privilege to speak at this platform and especially on this topic. And as Mahendra bhai rightly summarized, that now you have to look at two Finance Act. So at 5 o'clock, I called CTC office that please send the latest Finance Act and not the earlier one, though we are filing returns for AY 22-23. So I have divided the presentation into 4 to 5 parts. First, we would be discussing changes in relation to individuals, then corporates, then charities, then procedural aspect, as sir mentioned, updated return in case of a business reorganization, and at last the key changes in ITR. These are the broad 5 division of the presentation. Jumping into the topic proper, first coming to individuals. And just for the audience physically present, there have been minor tweaks in the slide deck which would go on. More it is an arrangement rather than anything else. So couple of slides, you may feel that the deck is different from what you have in your hand. So for individuals, the primary thing, no change in tax rates, no change in surcharge cess. So that continues as they were. The highest one still goes to 42%. For listed shares, you have 11.96%, which is the highest. The slabs continue to be the same, the exemptions continue to be the same. So the first broadly, there is no change. Only one small change is for section 89A has been introduced, which is for retirement, offshore retirement, which has very limited application. So if time permits, will come to that towards the end. What are the benefits given? So there are broadly two main benefits which are given. One is linked to COVID. So in last 2 years, what has happened is there have been illness, there have been deaths. So various employees have come forward and compensated for the medical cost. They have also compensated in a way for any demise. Lump sum amount has been given to the family of the deceased. So the act has been amended to provide at two places. One is 17.2, which is the taxation of perquisite, that if whatever expense you have incurred for COVID related disease, then you will get an exemption. It would not be taxed as a perquisite. But as now we also have any sum received without consideration, because this is ex gratia, it is not linked to the service you provide or anything. And it may be received from a charitable trust or a well-wisher of yours. So even not to tax that, they have also amended 56 to 10 to provide that whatever amount you have received is exempt. For medical expenses, there is no particular threshold which is prescribed. Upper cap is not prescribed. And for medical relief, they have extended this to that you may yourself have gone through that disease and incurred those expenses, or any of your family member has gone through that disease. That they have even defined what is family to include spouse, children of the individual without any linked condition. But if you want to say extended family in the era of nuclear family, parents, brothers, sister come in extended family as per them, and only if they are wholly or mainly dependent on you, then you will get this exemption. If they are not wholly and mainly dependent on you, say your brother is already having a good job and he can look after for himself, then this exemption will not come. So how do you define whether a 10,000 job or a 1 lakh job makes him wholly dependent on me or no? It's a gray area. There is saying that what is a necessity for a princess may be a luxury for a common man. So you don't know what is wholly or mainly dependent on you. And they have said that they'll prescribe conditions which are to be satisfied but till date, as I'm aware, there is nothing which is prescribed. So last assessment year has already passed where returns have been filed. There is no further way to update those returns for a relief which you want to claim. And for this year as well, the due dates are nearby. And it is difficult to see how, if the condition is prescribed now, how one would practically comply with those conditions. But broadly, one feels that it would be more of a documentation-oriented conditions, that you have to submit bills, you have to submit, say, doctor's certificate that your illness was related to COVID. It is not that you are diabetic and you are hospitalized and you are trying to claim this as a COVID expense. So it should have some linkage, which a doctor being an expert may justify that. And if at all they want to put something like the policy of an employer should be for all the employees and not for a specific employee, only for the promoters or the key employees. One doesn't know. This is only one is guessing what can come. And one additional thing which may come is if you are compensated already by the insurance company. In that case, a double relief may come in if you are further compensated by the employees or a charitable trust. So that would be a condition that your same amount cannot be claimed twice. So these are just thoughts one would feel that may come in the condition, but one will have to see. A technical debate may be raised that if there is conditions are to be fulfilled and conditions are not provided, then whether you can take the benefit of that section in the first place itself. So the views of judiciary are divided on the subject, but I would feel that it is more linked to the kind of section you are reading. Here it is a beneficial section. It was introduced retrospectively for 1 year. So obviously the condition would be prescribed later on. So to read that a condition has to be prescribed to take benefit of the section may not be the correct principle, but you have case laws under section 33AB, where a benefit was given to the taxpayer. There was that if you incur A expense, B expense, or any other expense which is notified by the government. For those any other expense notified by the government, notification was issued couple of years later. In that context, Madras High Court has ruled that it should be only prospective. But here again, there were two set of benefits which were already available, and it was only expanding the scope of those benefits. Here, otherwise, the clause would be rendered OTS for 2 years, which doesn't seem to be the intention of the legislature when a benefit has to be given retrospective. So I would read that if conditions are not provided and if they are not going to be provided with retrospective effect, only satisfying the preliminary requirement that the disease is related to a COVID illness and it is either you or your family and it is coming from any person, that should be good enough. No, sir. Right now, the returned nothing is there because this comes in the exemption part. They have not provided anything for. No, sir. In my reading,
I think here the question what Parimal Bhai is trying to say that do we have to treat this as an exempt income, and do we have to make any disclosure? That's a question what Parimal Bhai is trying to address.
Yes.
Right. Yes, spent from surplus is also remaining, but now, like in individual, no one mentioned anything.
Yeah, see, as far as receiving from employer to directly to his employee is concerned, Parimal Bhai, then there would not be an issue because even if he whether mentions it in his form 16 or not, it would be treated and exempted for this 17.2. So that should not be a problem. But if any family member is receiving or a disease, hair is receiving of their employee who was who has been diseased, there the question would come whether it would be treated as an exempt income. Then the section, it's not covered in any of our. It's exactly. So it's not an income per se itself. So I think as such, there would not be a requirement for any such disclosure. And since they have not specifically mentioned in the ITR that you're supposed to disclose, so that can be ignored. Yeah.
I would just say this is similar to if you are receiving a gift from a relative, you don't disclose. So,
proof of doctor that illness is related to COVID. If you know that individual, basically, I will say that I've experienced this. Doctors say.
I mean, people won't be able to hear online. That's also.
Nowadays in hospitals, they have something like COVID summary. That is very important document. Now another case is like in case of death row, that one they write about COVID. Here also there is a technical test. Medical room, they say that major cause of death should be COVID. That also is there. And secondly, as far as Maharashtra government is concerned, they are paying only 50,000 rupees as pay of compensation, ex-gratia compensation in the site. Then also you have to go there 3 times and in 6 months it takes to do. That's what I have experienced.
Yeah, so you're sharing your experience, right? There's no question to this.
The question is that proof of doctor in this related to COVID, these are technical things. It's not easy to prove it. When you face it, then you come to it.
Fortunately, they have not mentioned as required in certain cases. It should be this type of doctor if you have to claim any handicap certificate. So that's not mentioned here. Those conditions are not there. So any doctor who is qualified a doctor is sufficient enough to.
It's not like that. This case of senior citizens who get some complication, they are admitted and they get COVID. That cases are gray area.
Okay. Agreed, sir. But I have not researched. But what I recollect is already Supreme Court in the context of Insurance Act has already decided this in favor of the people to say that you should get the benefits. So broadly being a beneficial thing, the construct is coming in favor. But you are right, the controversy, our income tax officer, one can never rule that out.
is insurance company,
Not with income tax. Because it has not been tested, no, renewal way.
They are saying the doctor was not required and you are hospitalized.
Yeah.
Okay.
It was not so severe to be admitted for that. So this is the basically
Problem with the insurance company, fight between the insurer and the insurer.
That time you require some specific COVID related illness.
Right. Yeah. I think that should be, yeah.
So there is a comment from Vijay Mehta to say that it is not an income at the first place, so question of treating it as exempt income does not arise.
Yeah, we have addressed.
Yeah, I agree. It's a windfall and it's a capital receipt. But once an exemption is provided, it is difficult. One is always debating in the context of 56 to 10, half of the exemptions are income or not in the first place. But difficult to practically argue. But yes, technically, I would agree that it is not income, it's a windfall capital. Moving to on demise. So it is almost similar to what you get as an expense. Only thing is on demise, you should receive it within 12 months of the demise. And secondly, for employer, there is no cap, whatever amount he gives. But any person other than employer, the cap is of rupees 10 lakhs. Beyond that, they intend to tax it under 56 to 10. Again, we don't know the condition, but we have heard that few employers have given to their employees or the family of the employees who have died, say will remunerate, he will give salary till his retirement. So in those scenarios, after 12 months, this will become taxable. Few of big companies, we have all read in papers that they have extended this. So the point is there a way? So what one could look at is one could give a debt instrument. Say I'm issuing a debenture. So it is issued within 12 months. Every year it will mature. So you are issuing today, the fair value is the cost of acquisition. And every year it matures. There is no capital gains tax really which you have to pay. So that's the option one can look at. But otherwise, this is something which is uncalled for when someone is compensating for demise of someone and you intend to tax that. The argument being if he would have received salary, he would have paid tax. So even this should suffer the same tax incidence. That's the argument being done from the other side. Anything specific on this?
I think, yeah, we can.
Yeah, we can. Yes. Yeah. So it is. It will go in because there is no employer-employee relationship. It will go in 56. It will. Yes. Will not. Yes. So this is has very limited applicability. I'll just run through it, and if anyone has anything, please. Basically, Section 80EA is a benefit which is given to first-time home buyers, and you get an additional deduction of 1.5 lakhs. But your stamp duty value of the house should not exceed 45 lakhs. This benefit was already there. It was up to house purchase up to March 21. Now they have extended it to March 22. So that's the only change. Only one thing to be noted, it is though it reads as new home buyers, you may have a house earlier. You could have sold that. On the date of loan, you shouldn't own a house. It shouldn't be that in your history, this should be the first house purchase. So it is not first house purchase, but on the date of loan, that should be the only house you have. That's how the condition is. You already have interest relief under the head house property of 2 lakh. So practically, if you work out the math, it is very difficult to reach 1.5 lakhs. Max, one would generally land up to 60,000-70,000 of tax saving in this clause.
Here, Abhitan, the question people would have is that do we have to look only to the stamp duty value, or if the agreement value is say more than 50 lakhs, because the condition here is of stamp duty value price does not exceed 45 lakhs. So in an example, if it is 50 lakhs is the stamp is the agreement value. And the stamp duty value is 45, still whether he will qualify for this deduction, ATEEA?
He should, because wherever they wanted do that comparison like 50C,
yes,
or now even in the TDS section of 194 IA, they have provided that.
For stamp duty purpose, the value is the agreement value or the valuation, whichever is higher.
Yeah,
So stamp duty
so
value
that's why the question is.
No, they are saying stamp duty value of the property here means the ready reckoner value.
Ready.
And not the value at which you have to pay the stamp duty. Otherwise, this distinction doesn't work. So now, coming to the one of the key changes which has happened for individuals is taxation of provident fund and ULIP. Till date, we didn't had any cap on contribution to be done in provident fund. Now they are bringing in a cap that if you contribute more than 5 lakh rupees in the provident fund, say 2.5 lakh is contributed by you and 2.5 lakh by your employer, or if the employer is not contributing, you are contributing 5 lakh rupees. If you contribute more than 5 lakh, whatever interest accrues annually would be treated as income from other sources and would be liable to tax. Though you are not receiving a penny, but you have to pay tax on that year on year. And they have amended Rule 9D to provide that now the PF department will have two separate accounts. One is non-taxable account. So whatever your contribution is till date, luckily they are not touching that. So in earlier years, if you have contributed more than 5 lakh, that is safeguarded, that is part of the non-taxable account. But whatever you contribute from 1st April 21, if it is more than 5 lakh rupees, then the additional amount would be part of a taxable account, and interest accruing on that taxable account has to be offered to tax year on year. The second amendment is in relation to ULIP. Again, this is a good prospective change. Basically, it will apply to policies which you have taken after 1st Feb 21. That is the day when the budget was presented. That if the premium on the policy is more than 2.5 lakh rupees, you won't be entitled to the exemption. If you have multiple policies, then aggregate premium should not be more than 2.5 lakhs. So take an example, if you have one policy of 1 lakh, another policy of 1.25 lakh, and one policy of 1.8 lakhs. So if you add first two policies, 1 and 1.25, you reach to 2.25 lakhs. Now, one would have added the third policy to come to 4,05,000 and claimed 2,50,000 as a deduction. But that is not how the section reads. It only says that you have to aggregate the policies whose total is not 2.5 lakhs. So you have to add 1 lakh and 1.25 lakh. So your deduction is 2.25 lakhs and not 2.5 lakhs. So that care has to be taken. It is policy-wise addition. And it is not like overall there is a cap of 2.5 lakhs. So only the first two policies will qualify. Good thing about this is this would be not taxed annually, but whenever you liquidate, it would be taxed as a long-term capital gain or at 10% and on which STT has to be paid. And this benefit is also for ULIP, which are not only in equity, but also a debt or a mixed ULIP, mix of debt and equity will also qualify for this benefit.
This would be exempt, or as I cross 5 lakhs, the entire interest is
PF? No, so two separate accounts. Up to 5 lakhs, one account, everything exempt which is there in that account, and more than 5 lakhs in a separate account with separate accounts. Yeah. Yes.
There's a similar question in the chat box which says that we cannot see any TDS for interest earned above rupees 2.5 lakh. As discussed with one PF expert, the interest on such separate account will become due after 1/4/22, and hence no such amount will be taxable in FY 21-22. Well, just because not TDS is not deducted, that does not mean that it is not taxable. I think he's trying to say that because there is no provision, it doesn't become taxable. I would not agree to that. The law is, if it is taxable, it is taxable.
Right. And just to supplement that, even the ITR has been modified. In income from other sources, a new entry has been inserted of PF on interest, PF interest, which is not exempt. So even the legislature and CBDT feels that it is taxable from this year.
So regarding the policy, first two policies would be 2.5.
Policy is ULIP.
Yes, policy ULIP. You say 2.5 lakh. How do you repeat that example?
So basically, if you have taken 3 policies, you have to see that your aggregate, which is the highest, say one is a 2 lakh policy, one is a 1 lakh policy, and one is a 1.25 lakh policy. If you take the 2 lakh policy, you will get 2 lakh because adding any other policy will cross 2.5. So if you take 1 lakh and 1.25 lakh, you will claim for 2.25 lakh. But you cannot claim for 2.5 lakhs because aggregate amount you have invested in ULIP is crossing 2.5 lakh. It is not like a normal 80C. And if you contribute 2 lakhs, you get 1.5 lakhs. They are looking policy wise and not aggregate wise.
And there cannot be an interpretation that just because I contributed more than 2.5 lakhs the entire policy, I will not get benefit of it.
Very hyper technical one, you may try discrimination. Because if I take different policies, you give me 2.5 lakh. If I take one policy of 3 lakhs, you don't give me. Other than that, no scope on the language. I'm told that there is a cap where he cannot contribute. Sorry, he can, and that is not something which they are covering right now. They are only focusing on employee contribution, but I would like to confirm that once. Previous year it's okay.
So that was employer's contribution was earlier also taxed.
Okay.
So here this 2.5 lakhs you have to take with GST.
You will GST PF contribution. So the act comes handy.
The policy is with GST.
With GST, no? In Mediclaim,
They say premium.
in
The word
Mediclaim,
used is-
ATD, do we claim with GST or without GST?
See,
There's a conflict.
Mediclaim is an expense, and if you don't get credit of GST, it is an expense for you, and you should be entitled to it. But here they are, to my mind, more.
I think GST is part of the premium.
So the premium paid GST element is not part of the premium? For any policy taker would say that, look, this is my expense. I am being expensed out by that. So I would take a view that yes, it should include the GST element should include the premium.
Better to go with the ATD certificate. Some companies give with GST.
Some companies include GST. You mean to say some do not also? Including GST. That's what even I think so. Yeah. And
Possible to take a position both sides because it was premium payable. So for me, GST, if I don't get credit, that's a cost.
it's a cost. Yeah, that's what. Yeah.
But if hypothetically I have a policy of 2.4 lakhs and GST makes it 2.6 lakhs, I would prefer to say that it's only the premium. So
you can take the benefit.
yeah.
Okay, for the online, we can repeat the question. Friends, here the question put was whether this 2.5 lakhs is to be considered with GST, and the answer is yes, it is to be considered with GST. Yeah.
Yeah. And you're looking
Yeah.
at the chat.
Yeah, that I think we have covered. It's okay.
Okay.
Yeah.
So I think this brings us to the end of individuals. Moving to corporates, again, no particular change in rates of tax. So directly jumping to the topic proper, what I have done is I have first put in the incentives. There are very few, lightens the mood, there is something good. Then there are 10-15 slides which comes on the disallowances or the restrictions which have come in. So broadly running through the incentives may not have general application, but these are the only few incentives provided in the last two finance acts. So first is startup, again, nothing really a new incentive. Only the period of incorporation by Finance Act 21 was changed to up to 31st March 22. By Finance Act 22, it has been changed to 31st March 23. Similarly, for affordable housing project under Section 80 IBA, the project approved for the period has been extended from 31st March 21 to 31st March 22. Only new section which has come in as an incentive is affordable rental housing scheme, which is a subsection 1A of Section 80 IBA. But it is difficult to understand what they are trying to cover. From broadly what one understands from PM's website on different schemes which he runs, that they are going to come up with something affordable rental housing scheme 2022, where they have covered that this is an income tax benefit which they are going to provide. Otherwise, in Income Tax Act, it is very limited. This issue comes up because the project has to be approved by the central government before 31st March 22. At least on the income tax website, there is no such project which is approved, but I am not sure income tax is the right or the only website where this approval would go. So otherwise doesn't have again a general application, only limited to the projects which are approved. A normal chapter 6A deduction has been provided. Yeah. Now coming to the two most controversial amendments or two more having far-reaching impact is one is deduction on education cess, and then we'll come to the section 37 explanation on expenses incurred in relation to which are prohibited by law. So to give a background, generally whatever income tax one pays is never considered as an expense. In a computation of income, you start with either profit before tax or you start with profit after tax and add back the income tax provision, whatever is there in your books. But somewhere in 2018, there was a Rajasthan High Court decision which said education cess is not part of tax, relying on an old circular and analyzing rule that this is not part of tax and therefore section 40 will not apply. Whether section 37(1) you can claim it was never discussed, but section 40 will not apply and was ruled in favor. Later on, somewhere in 2020, it was followed by Bombay High Court in the decision of Sesa Goa. So there were umpteen number of additional grounds filed before CIT appeal, and ITAT. I was just seeing the forward of Sesa Goa. You have just in 2 years, more than 100 decisions have relied on that and given in favor of the taxpayer. So one can just understand the gravity of claims, additional claim being made on the subject. So in Finance Act 2022, they got in with a retrospective amendment to clarify that education cess cannot be allowed as a deduction. It is retrospective since April 1, 2005. That is when the education cess has been introduced. So one has to really question, and a topic for a separate discussion is it took them 3.5 years to realize High Court decisions and then come up with a retrospective amendment. And if I may put it, the audacity is section 155. Now they want you to come suo moto and tell, okay, this was a mistake. I am making an application for a rectification of error, so to say, and you please pass a revised 143(3) order, or you pass a rectification of mistakes order. And if you don't do that, it is not that only that you have to pay tax. I'll levy a penalty and I'll say that this is deemed to be under-reporting of income under section 270A. So that is how they have amended, and they are trying to make sure that everyone suo moto files it rather than they have to really enforce. That's the broad objective behind this amendment which they have done. Anything specific? Otherwise, I'll get into the technical part of this discussion, whether one should file 155, and I'll start with the caveat. It is a bit academic because today litigation is an expensive hobby. One cannot have. So anything you do not filing a 155, definitely you are inviting litigation, and one has to decide on stakes and one's appetite to litigate against the tax department. Yeah. Yes, forms will be prescribed. They have not prescribed it yet.
The forms which they are prescribed, they are asking, they mentioned that the forms will be prescribed.
Yes, in 155 they are saying that it would be, you have to do it in a prescribed period, and there would be a form where, or you make an application.
You can make an application. I don't think so that a form is required. You can straight away make you need to make an application to avoid your penalty provision.
But the period is not prescribed yet. And in the online era, possibly you will have some form, I feel, though it is not technically part of the rules. Whether you'll go to your assessing officer or you'll make it to the CPC, it is a bit internal for them. But once they prescribe the period in which you have to file, we will have better clarity on subsequent steps, whether it has to be a letter or a standard form or something to be filed online, but no visibility on that yet. And as Mahendra sir rightly said, technically they don't have to prescribe a form under the section. They have to only prescribe a period. So we'll come to that. Whether so CIT appeal would be so your question is whether a proceedings are pending before an appellate authority, what would happen? If it is an additional ground for that matter, you can withdraw the additional ground. But for example, if you have already won in CIT appeal and department is in IT80, the IT80 in all probability will rule in favor of the tax department because of the retrospective amendment. So moving to the issues, as I said, constitutional validity, can you levy a penalty? That is fiction without, and where my bona fides are beyond doubt, there is no contrary high court ruling. Why would assessee take a stand different from what two high courts of the country have opined? Then can you just deem that if I don't file a disclosure form, it is a fit case for penalty? So one has great doubts on that. Now coming to few of the technical points. One is that no, it will not fall in misreporting, because the clauses of 278, 8 and 9 broadly are for, say, bogus expenditure, or something which you cannot substantiate. Those 7, 8 clauses which are there, on a close analysis, one feels that this is not something, this was a judicial decision being followed. So it is not a misreporting. It can only go to underreporting. So if at all 50%, not 200%. That is what one is looking at. Section 71 1C is not amended. So up to AY 1718, there is no penalty. Only amendment is what they have amended 155 is to deem it underreporting under 270A. But these additional claims have been filed almost for all the years. So no penalty issues or consequences for earlier years because it is not amended. Again, a technical point, whether you have to amend for before 1718 or not. There are two arguments to say that you don't have to amend for 1718. Say, for example, the assessing officer gave you relief, there is no outstanding proceedings on the subject, or CIT appeal gave you relief, there is no outstanding proceedings on the subject. To rectify an order, they are saying the period of 4 years will start from this assessment from 1st April 22. there is a Gujarat High Court and there you have Delhi High Court SLP dismiss that if the period of rectification has already expired on the date of the amendment, then the amendment will not apply. For AY 1718, 4 years expire on 31st March 22. So amendment applicable from 1st April 22 does not apply. The facts of both the case were identical, a change in reopening period or a change in TDS provision, where instead of 3 years, it was extended to 6 years. So whether 6 years, if 3 years have already expired, the new time limit will not apply. If the period is ongoing, say 2.5 years have been completed or 2 years, then the extended period of 6 years would apply. So that is one. Second is the way section 155 is worded. It uses the word and, that there has to be a recomputation of your income to add education cess and a levy of penalty. Now the levy of penalty can only be for the years covered by 270A, cannot be for the years covered by 271 1C. So two propositions to advance that it is not covered. And now coming to another aspect, that if there is a 143(1) order and there is no 143(3) order, can you do a rectification? Because rectification is when there is an order and there is a mistake apparent on record. So what hours do you have in 143(1)? There are 3 adjustments broadly to be made. Arithmetical error. This is not an arithmetical error. Incorrect claim apparent from information in the return. In return, this is just a 37(1) claim, part of the overall expense being claimed. There is no separate apparent information in your return. So that will not apply. Third is disallowance of loss or deduction due to time limits. Again, that will not apply. So technically, again, whether 143(1) can you file 155? Obviously, if you file, they'll accept. But there is an argument to be made that one need not file if your case was not picked up for scrutiny. So cases were already disallowed in assessment order. Nothing to be done further. If you have not appealed, no penalty, end of story. And if ITAT has given you a release and say because of low tax effect, the department is not in High Court. Really, the 155 read with 154 only empowers the tax officers under section 119, which includes your assessing officer, commissioner, CIT, principal CIT, doesn't include ITAT. So 155 and 154 doesn't apply to ITAT. ITAT only has 254. 254 the time from the date of order. I could say that rectification of mistake apparent on record is even for a retrospective change in law. The reason being, it is deemed that the law was present on that date and you have ruled something which is against the law present on that date. So you can rectify. But there again, the time period is only 6 months. So if the department doesn't file an application of rectification within 6 months from the date of the order, I don't know, subject to condonation of delay, technically 254 is a non-starter. So this is broadly the analysis on education cess. I'll wait for a couple of minutes for anyone if has questions.
Can you come to your slide, Abhitan?
Sure.
Yeah. First of all, applicable only from assessment year 17-18 would be, I would say that the reason, yes, you have rightly mentioned that 4 years 154 allows, but this being a mistake and since the law provides, so they would definitely tell you that yes, you can make an rectification prior to 17-18 also. And I think 17-18 more so they have said because here the Gujarat High Court decision, I'm sorry, Rajasthan High Court. The first decision was of the Rajasthan High Court. So Rajasthan High Court decision, by the time it would get, people would be aware of that decision and they would start taking action on that, and thereafter followed by other so many high courts and CISA Goa also. So 17-18, it's all after those 17-18. So that would be the reason why also they would suggest. Coming to your point of where 143, one item, the only 3 items that you have chosen, that for 154, if it's a mistake apparent from record, then do we have to see these three conditions? I think we, well, you can answer to that little later. You can have this, yeah. So that is one point which I think you need not have to look to these conditions. You can straight away, it's a mistake apparent from record. And now since that amendment is there, retrospective is there, and they are trying to say, not retrospective, they're saying this is what we otherwise also had thought of. This is what the law was according to the legislature. So that would, it means since that was the law already there, so it's a mistake apparent from record, and now you need to carry out this rectification. Yeah.
Then online, we put under one rectification 150 resources that is the reasons.
Yeah, that is what he is saying.
What he was telling, online form is not prescribed. So under rectification proceeding, 154 resources were written and write the reasons.
Exactly. By giving the reasons, you can giving the reason that yeah, this is the amount of cess which was present business expenditure needs to be added back. So that can be done. That's what, yeah.
Just on this 143. So what is 154 really? 154 is a rectification of a mistake apparent on record of an order passed by authority under 119. So what order was passed under 119 was 143(1) order. What he's allowed to do in 143(1), three things. Has he done a mistake in doing those three things? No. 154 is not an independent section. Any 154 order is read with 143(1) order or read with 143(3) order. So the power of 143(1) should first permit to do that. Then you can come to 154 for that.
Okay. Okay. I understood. So, but will it not form then an incorrect claim apparent from an information written?
Absolutely. So that's the point. Is there a information in your ITR where education cess is there separately? Which is, to my mind, not there.
Yeah. As such, there would not be a separate disclosure in your return of income, definitely. But as an SSE, you know it, that this is what the cess amount was. You have not disclosed this separately because there was no requirement to be shown separately in your ITR. However, it was maybe clubbed as other expenses in your ITR and claimed that as an expenditure. But now since you know it and there was no 143(3) done, so this was never brought to the knowledge of the department. But you so moto do it, otherwise we will levy penalty on you. That's what they're trying to say.
Absolutely. As I said, you do it, they'll accept. Only thing is it apparent or not? It is there definitely in my working files. I have everything.
We would discuss one thing that in TDS, even though it is there in 26 years, they are saying once you have not claimed, that it is not apparent from record.
Oh.
And they are not allowing additional TDS to be claimed in under activity. Application is not getting filed. The system matches.
Yeah.
2-3 minutes, please have it.
No.
Or I will take up.
So just one point,
Yeah, this later.
Yes. So whether you have to pay interest under 234B and C, because this is a retrospective amendment. How in the world I would have predicted after Arun Jaitley saying that we won't do a retrospective amendment, that you come up with a retrospective amendment with 2005 and you try to defend, that's your part of story. But how so, and how can I be, considered as a, how to put it, but Jyotishi, that I should have paid my advance tax, that there is a astrologer that I should have paid my advance tax. So that's precisely the point of the two High Court rulings, that if a tax liability comes due to a retrospective amendment, you need not compensate for interest, because interest is for delayed payment. And here you didn't knew that this liability would be fastened on you. So you don't have to pay. You also have a Supreme Court similarly in the context of TDS. where a retrospective amendment was done in section 9, which expanded the scope of royalty, and due to which TDS obligation came in section 195. Supreme Court said this is theory of impossibility of performance. How could at the time of deduction, I would have envisaged that there is a retrospective amendment which would come, so let me deduct it right now. Similar thing is for your payment of advance tax.
In notification also, I think retrospective amendment is covered. There are two notifications.
So yes, so there is a 119 notification which is there, which is the last point. But the problem is the notification reads that it should be after the end of the relevant previous year. So for the last year, the Finance Act was enacted sometime in the last week of March. So it is not after the end of the relevant previous year. So for the, I have reproduced that extract of the notification.
Notification say only there is amendment, retrospective amendment. Interest cannot be waived.
No, so you can make an application, but it says that as a result of retrospective amendment after the end of the relevant previous year, certain receipts which are treated as exempt become taxable. So basically the problem is after their catch is after the end of the relevant assessment year, previous year, and possibly when the notification was introduced. We had budget at the end of February. It was always passed in the month of April. So it was not possibly envisaged in 96 that we'll have a Finance Act which passes before the end of the previous year, which would do a retrospective change. And technically as well, one may take a position it is not a retrospective amendment because the law on the first day of the assessment year is relevant. Sir, but income tax doesn't go by previous year. It goes by the assessment year. Your liability to pay tax is on the first day of the assessment year. But one can argue that liability to pay advance tax is during the previous year. So it is retrospective to the extent I have to pay the liability of advance tax. And judgments are there. We have also quoted those. Only thing is whether revenue will deny. They have written a explanatory memorandum for almost 4 or 5 pages justifying this amendment. So they say this is always the intention. And if you, it's okay. So
that's the, yeah. That's precise. I was trying to say that, Abhitan. The Supreme Court decision of engineering analysis, there the Supreme Court was trying to say that here you have extended the meaning of the word royalty. Because of this extension, these certain payments which are otherwise not treated as royalty now fall into the definition of royalty and you are liable to TDS. Therefore, the meaning of the word itself was extended after the amendment. And but that was done retrospective. That's a retrospective in that sense. The scope was increased. Whereas in the case regarding the applicability of the retrospective is whether this was existing in after 2005 itself or not. Say if we are in assessment year 17-18. In 17-18, what was the law? That was a debate whether this cess is forming part of tax or not, allowable or disallowable under section 40 or not. That was a debate which the court said it is not to be allowed, not treated as a tax and should be allowed as a business deduction. And thereafter the legislature tries to say that, look, our intention, and not only our intention, it was always to be treated as a tax. It is not to be allowed as a business expenditure. So it's not that they're trying to increase the scope. Therefore, I would say to that extent, the department will try to distinguish the Supreme Court decision. Now that they have 3 pages of this memorandum written on it, because they are aware about that, yes, what they're trying to do is something not justice at all. Therefore, they're trying to justify themselves before anybody comes up. So this will be a problem. If you ask me, I would even say that to a greater extent, 234B and C will also be levied. The department is going to levy this 234B and C. If then you may file under 119 to the CBDT and saying that, look, it was not possible for me, as you give all the reasons, but you will have to fight your case for that. Yeah. Yeah, sorry. Yeah. I'm sorry. B only. I appreciate what you said. C cannot be there. It can be only B. Right.
Just digressing, but a good point to consider a representation, at least in this order, should be removed. I agree. Now, it is not anyone's application of mind, it is really CPC who determines the computation. So,
they came up and they done retrospective audit. They had specifically removed interest to the DC.
Yeah.
So based on that, Chidambaram had done it.
One question here is what we discuss, of course. 3 limbs you mentioned are of 143(1) and do not emerge from section 154. It can, yeah, that's what.
Yeah.
So that has been clarified that the form has to be prescribed. 155 subsection 18 says the application to AO should be in prescribed form and within prescribed time.
Okay.
Then I stand corrected. Yeah. Okay.
So it's a good question. Then we said that since you are not prescribed yourself, I had all the reasons of not filing an application. You can wait कि उन लोग चुक जाए तो अच्छा है. If they don't,
how can you ask interest? You are not prescribed the form.
Yeah.
Possibly, if you don't want to get into litigation, pay your self-assessment tax or advance tax on the portal. You can do it for that year. You don't have to wait for the form. Because again, litigation.
Yeah, we can proceed.
So, coming to the second key amendment in the computation part is the explanation to section 37. Again, this came in Finance Act 22, but will apply from AY 22-23 itself and not from AY 23-24. So what they have provided is, presently we have that expenditure which you incur, which is prohibited under law. It should not be allowed. And there have been numerous litigation on what is prohibited under law. They have picked 3 instances which they felt should be covered in the ambit, but in all the 3, judiciary have opined in favor of the taxpayer. So the first one is that what is the scope of a prohibition by law? Whether you have to look at only India or even outside India. You have a decision of Milan Laboratories, which says that offense, so to say, was committed in Europe by a pharma manufacturer and a settlement was done there. So whether it will apply, the 37 disallowance will apply or not. So the tribunal, very well analyzing the meaning of the word law, referring to General Clauses Act, referring to the context in which the amendments were made, in a very detailed discussion, then concluded that only the law for India is relevant and law applicable outside India is not relevant. And rightly so. If an Indian company for any reason has flouted a foreign law, how are you concerned? Why this is here? The Income Tax Act is used as a governance mechanism, as a deterrent to do something wrong in your jurisdiction. Why are you concerned with a foreign jurisdiction? What is happening? And especially when it comes to commercial laws. For example, Milan was a case of trademarks. You don't know who is right. Sometimes you just reach to a settlement to avoid protracted litigation. For peace of mind, you come to that. Why are you bothered? But we have this amendment, and even any offense outside India also it has to be looked at. And so the question arises is whether there has to be a conclusive proceedings. Whether, the governing authority, say in India or outside India, first should say that there is a offense and there is a penalty, or there is a finding that he is guilty of an offense. Most of the time a proceeding is initiated, but it is not concluded that he is guilty of an offense. Say for example, freebies, the general example. Indian Medical Council has to monitor whether doctors have received anything correctly or wrongly. And if it is in violation of the council guidelines, they have various sections on how penalty to be levied, how they will be suspended. But the medical council hardly does anything. But the tax department feels that whatever gifts the pharma company has given, it is in violation of the guideline, and therefore it is a disallowance. So in this context, we have a decision which one can look at. It is really in the context of section 10, whether a SEBI, this was a case of a fund, whether a SEBI regulation is violated. So AO said, okay, I'm reading the SEBI regulation, your net worth criteria, these criteria are not fulfilled, so I will not give you section 10 exemption. Nothing was done by SEBI. So the tribunal came down heavily that you are an officer of Income Tax Act. You know to read the Income Tax Act. There is a governing authority for SEBI, which is SEBI for the funds. And if they have not done anything, it is not in your purview to say that he is flouting the regulations and therefore he is not entitled to the exemption. So it would be a good analogy one could look at, that there has to be something which is initiated by authorities under which law you are being alleged that you have violated. Again, whether offense, say something may be an offense in, say, a Sharia law in Dubai, which may not be an offense in India. So a violation in foreign law, whether it has to be, which is also an offense in Indian law, has to be looked at, or just an offense simpliciter in the foreign country. Like Sharia law is very different. There may be an offense which may be something normal for India. So which law has to be looked at? Generally the law of the country in which the activity is carried on is to be looked at, but there is no complete clarity on that. Coming to the second clause. Second clause is on violation of any rule or regulation or guideline. So if you provide a benefit or perquisite to a person, whether he is in business or not, which violates a rule or a guideline applicable to that person. Again, why this came in? This is because of freebies. Freebies, when the finance bill was introduced, you had a high court in favor, MP High Court, which says the medical council guidelines is applicable to doctors and not applicable to pharma. Relying on that High Court decision, there were numerous tribunal decisions which said under income tax that it is not an offense for me to give a freebie. So there shouldn't be a 37(1) disallowance for me. It is an offense for the recipient, and therefore whatever you want to do, you do it in his hands. You want to initiate proceedings under medical council wants to do, they can do it, but it is not my offense. But we had somewhere in end of 2021 also a decision of tribunal, which has been heavily quoted in the explanatory memorandum. So they have amended it, and you already have, by the time in May or June, you have decision of Supreme Court which says that it applies to the pharma players as well. Long and short is they are saying that if it is an offense in the hands of the recipient, you are also prohibited from doing that activity. They have relied on the corruption law. If receiving corruption is an offense, even giving receiving bribe being an offense, even giving a bribe is considered an offense. That is how Supreme Court has looked at it. And that is the analogy they have applied. This is a more of a moral or ethical question than a technical question. That is how Supreme Court has looked at it. But now coming to few issues because of this freebies amendment. So,
Yeah. Before Abhitan comes to the few issues, let me take up what he has already discussed in the earlier slide. Abhitan, if you could just earlier slide, if you could take us to. That is explanation 3. Yeah. Here, if you see, friends, the wordings used are for any purpose which is an offense under or which is prohibited by any law. So first of all, it's an explanation 3 which has been introduced, and they are trying to increase the scope of the section. And they're trying to explain what would you mean by an offense or which is prohibited by law. So first it is saying any law. Therefore, the earlier decisions what we had possibly of the SEBI, what you discussed, or outside India also, for like yes, in London, that Maya was outside India, and there possibly activities what you say would be an offense, which is otherwise not to be considered as an offense also, maybe if the same activity is carried out in India. But since it's an offense under the law now outside India, they have expanded the scope. So very technically, if you ask me, this will create a problem, and these decisions what we have been trying to rely on may not be very helpful. Second point is regarding, so the basic question what we have to now will try to address is, what do you mean by offense? Okay, that is what he's going to take up a little later. So I think, so that was the first point, and now I think you can carry on.
So coming to changes on freebies, basically. So whether we have covered this point, and Mahendra sir has also said that whether a IMC proceedings, a contempt or a ethics committee proceedings against that doctor who has received a gift is required or not. Second is whether a guidelines which is non-statutory in nature. For example, if a audit firm has a policy that none of the staff should accept a gift from the employee which is more than 500 rupees. And if they accept a gift of 5,000 rupees, so whether that would be covered, because the phrase which is used is very wide. It says that violation of any law, rule, regulation or guideline. So whether guideline will include this. But looking at the company of words the word guideline has, the principal noceters, adjustum generis and noceters sorry. You have to read the word in the context, and it is known by the company it keeps. Otherwise, guidelines is a very general word. If you enter into IMC and if they say they don't throw any litter, and if you throw and there is a 500 fine, that's also a violation of a guideline of IMC. So whether it is triggered by 37(1), possibly no. This should have some kind of statutory backing. That is how one may look at that. Coming to a few interesting issues to discuss is the two explanations, 1 and 3. Both use the phrase in India or outside India. However, it is not there in number 2 means. So whether the decision of Milan is still a good law when it comes to, say, giving gifts to a foreign doctor? It is a question mark to my mind. No, because you already have a Supreme Court which says that you cannot flout a guideline. But again, Milan is saying outside India, but more of an ethical question, as I said, and I don't see judiciary opining in favor. But one interesting aspect which came across for when we were analyzing this is, if you see the medical council guidelines, it says the doctor should not accept gifts from pharma companies, and following are the consequences. So the consequences is gift in the range of 1,000 to 5,000 rupees, 3 months, you will be given a notice, means a warning. Gift between 5,000 to say 20,000, my numbers may be here or there, pardon me for that. But then 3 months suspension, and so on and so forth. It is provided. So for gift up to 1,000, there is nothing which is provided. That they have an opening general statement that you should not take gift, but no penalty, so to say, is provided. They have even gone ahead and provided a warning for 1,000 to 5,000. So whether they feel up to 1,000, it is common courtesy. Sending a sweet box on Diwali will not influence the doctor's mind whether to prescribe your medicine or not. And as a social courtesy, you are giving a token. So that should be out that one feels, but the guideline is not very clear on the subject. So may lead to some questions, because this 1,000 put together for pharma companies runs into few crores over the years. And you don't know whether 1,000 is for each gift or for each doctor for each year, because medical council doesn't have anything for a year. It's a general guideline. So
in that case, medical council guidelines apply to Indian doctors. One can argue that the foreign doctor is not covered by medical council.
Absolutely, you have to see the guidelines applicable to him.
Guidelines will,
but something will apply to him as well. So
foreign guidelines will check.
Yes. One very interesting thing, whether cash gift is covered or not. Because if you see the language, it says benefit or perquisite. You have a Supreme Court to say cash is Mahendra for 28(4), that cash is not covered. So will you say even if you flout the guideline, this is okay? Answer is no, because now you have a Supreme Court which already says that you are covered in the general clause. The general 37(1) explanation presently as it is good enough. But this explanation 3 proper doesn't cover a cash gift, but still because of the Supreme Court ruling now, you would be hit. If for a moment the Supreme Court was in your favor, then this argument could have been advanced, but not today. Coming to the last part, which is to my mind the most uncalled for out of the 3, compounding of an offense under any law for time being in force in India or outside India. So they say compound an offense. So what do you mean by compound an offense versus compounding fees? First, there has to be an offense. Offense means admission of guilt. For example, SEBI has both type of orders, where you admit your guilt and one is where you don't admit your guilt. FEMA says that process of voluntary admitting the contravention. So you have contravention, but it is not guilt, or it is not an offense, so to say. That is how a tribunal has looked at it. We'll come to that in a minute. Code of Criminal Procedure says that it is a admission of guilt. So how will you look at this? Whether compounding fees you have paid for a peace of your mind, for your reputational risk, or there is an offense which is there. So what do you mean by offense? General Clauses Act defines offense means shall be an act or omission made punishable by any law for time being in force. They have used the word punishable, which is a strong word, which has been interpreted by 2 high courts in the context of income tax itself to say that offense first is in the context of General Clauses Act. Again, for income tax, it says that it has to do something with criminal codes, and offense and penalty is different. So if you are paying a penalty, it is not an offense. Offense, you generally pay a fee, or there is an imprisonment which is there, and that is compounded by you. But if there is a penalty which is there, it is not an offense. Again, the Allahabad High Court also says categorically, for example, penalties which are imposed in income tax or by income tax authorities cannot be regarded as punishment awarded for an offense. So in my summary, one has to divide that what is a permitted violation subject to consequences versus a non-permitted violation. Permitted violation are something which the liabilities are civil in nature, versus what is not permitted, where liabilities are criminal in nature, where prosecution is there, your criminal proceedings are there. Those should come in offense. So whether one can then say all your penalties are allowed in 7(1), the answer is no. You have a Supreme Court ruling way back in 1961 to say that any penalty is not allowed, as a deduction under 37(1). But then it has been further mellowed, or I would say the rigors have been reduced by the decision of Prakash Cotton Mills in 93, which says you have to analyze whether the penalty is compensatory in nature or a penal in nature. If it is compensatory in nature, then it should be allowed. And if it is penal in nature, it should not be allowed. So it would depend on your reading of each regulation, each law under which the offense is there, and to decide whether it is first, is it step one is it for an offense or it is not for an offense? So say it is not for an offense. So then is it a penalty? Penalty, is it for a penal in nature or is it compensatory in nature? Only if it is compensatory, it should be allowed. So I'll briefly just run through 4-5 rulings in which it has been held that it should be allowed under 37(1).
Prakash Cotton was under BST Act. They said distinguished 36(3) is in the nature of compensatory payment, and 36(2)(c) there was a penalty which say it is not allowable.
Right. So generally interest, something like interest is compensatory. Yeah. So you have contradictory ruling in the context of compounding fee paid by a builder for regularizing the building plan. You have Mumbai Tribunal, Hyderabad Tribunal, which are in favor, but you have Pune Tribunal and Punjab and Haryana High Court, which are against. They feel these penalties are, you have done something wrong. If you read the Mumbai Tribunal, it says it happens. It's almost routine that builder will do something which is not approved in the plan and he regularizes it. It is part of the business, the way builders operate. So there is nothing to say it is restricted by the act or you should not get it in 37. You have a decision of Mumbai Tribunal again, where a SEBI consent application was filed, where there again it was allowed in 37(1) to say that there is no reason to believe that the consent application without admitting guilt amounts to evidence of an offense having been committed. So basically here the phrase is very strong. They have concluded that it is not an offense. So even after the explanation, if it is not an offense, the explanation doesn't apply. Again, here it is a FEMA violation, the first decision, where it says that it is not a case where assessee has been held to have committed an offense or the amount has been paid or which is prohibited in law. Hence, explanation to section 37(1) is not attractive. So the RBI circular has a policy of compounding. You have compounded. It doesn't mean that it is an offense. It is, you have not observed a particular law, a fiscal law in a particular manner. So you are paying a compensatory price for that. Doesn't mean you are an offender. This is a decision under Motor Vehicles Act. Again, they have gone by that. It is a part of business that he has done 230 trips with overweight. It is part of the transporter's business. So this is not something which one should trigger 37(1) explanation to disallow. So I'll stop here for a moment.
Yeah, I think very nicely explained. And now we need to only take a call whether the provisions of section 37(1), that is the explanation which increases or tries to increase the scope by this explanation of these 3 points that he has raised, would be covered or not. Definitely, as he said, compound of an offense, compounding fees that we pay, whether it is for our violation of, I would not use the word violation, I'm sorry, the TDS, late deposit of TDS, when even if you have already deposited along with the interest, but for n number of reasons, you would not like to go for a prosecution and the compounding fees are paid, whether that would also be disallowed now in view of this section expenditure under section 37. would be a question. Definitely, I understand, because the word specifically they have mentioned compounding of an offense. The department would try to treat it as an offense, but as I would also agree with the view taken by Abhitan, that it would not become it would not be an offense as such. It's more of a compensatory nature, as even supported by Sharma, saying that under the GST, I'm sorry, sales tax law, section 36, you said, and 36.3 and something more. So under those law, if it's of a compensatory nature, it's not an offense covered and which is to be disallowed under this provision. So that would still hold good, according to me. I think we have other issues also, but this has been nicely discussed. So now we will straight away jump, for want of time. I would request Abhitan to be a little fast so that we can touch upon all other issues also.
Just for information, this 36(1) explanation is very well explained in an opinion given by Soli Dastur Saab in BCA old tax audit manual. It's very well explained, all the facets of. Of course, now we have to read with these changes.
We see that
if you don't follow the regulation, it is an offense and it is imprisonment of one. So, very appropriate. You are trying to avoid that provision of lemma where it says that it is a prosecutable offense by you. So, yes, the tribunal might not have considered that section. You need to look at that, and it's not going to be easy going ahead with that.
Right. Yeah.
So I'll skip few points. If someone wants me to cover, please put it in the chat box. But otherwise, I'll briefly touch upon 14A. It says now it will apply even if there is no exempt income. Very limited applicability, because now shares are being both capital gain and dividend income is taxable. One new thing is section 79A has been introduced, where they have provided that you will not get set off of losses in search cases against whatever undisclosed income is there. So even if you have losses and there is an addition due to a search of undisclosed income, the set off will not be available. You'll have to pay it. Last is, it was something last year and more of goodwill transfer, so we'll skip that for a moment. This is just a summary of key changes which were done last year, which were applicable from AY 21-22 itself. So just a refresher, the slide deck would be shared, so one may run through these changes as well. Coming to charities very briefly. Now what they have said that if you take a loan and you apply it for charitable purpose, or if there is a corpus donation which is applied for a charitable purpose, that won't be considered as part of application of income. So whatever your income proper is there, your normal voluntary contribution, that application has to be only seen. When it would be considered as application of income, whenever your normal voluntary contribution or your income of the charitable trust is applied for repayment of borrowing, or the funds where corpus funds were used are replenished by using your application of income. For example, you have received a corpus donation of 10 crores, you are making a building. So making a building is not application of income, but then the corpus is used. Now you have income from, say, a hospital which you have built. And if you replenish your corpus with that, basically invest it in permitted investments or deposit under 11(5), it would be considered as application of income at that point in time. A good thing, for example, if you are repaying a borrowing and not getting that as an application of income is a difficult one. So this helps, again, both sides, but broadly it helps. Second, which one doesn't understand why it is done so, but no carry forward and set off of losses. If I've spent more in a year, obviously next year my whatever income I get first would be towards those expenses. But if I don't get a set off, creates a mismatch. So one doesn't really understand what they are losing if they give carry forward and set off of losses. But they are restricting the problem may reduce. We'll see it in the next slide. And now you have to follow cash system of accounting and not mercantile system. But generally what would have happened is you would have made a provision in that year, which would have resulted into a loss possibly in one of the scenarios. And then you would have paid it out of your application of income next year. But now you won't be allowed that provision itself because now you have to follow cash system compulsorily and not mercantile. So is there a way to avoid this loss? So if basically when it is a case of loss, when income is less and expense is more. So we just saw that if you make that expense out of your corpus or borrowings, that is not allowed. So if you are coming into a loss situation, analyze that if you can borrow and make that expense or use your corpus to make that expense. So next year, when you replenish your corpus or repay the borrowing and you have a profit, this would be considered as application of income. So just to give a small example, if 30 rupees is your income and 40 rupees is your expense, so 10 is the loss. So incur 30 out of your income and for 10 rupees of expense, take a loan. So it is not allowed because you have used your borrowing. So this year 30, 30, 0. Now next year you have an income of 50 and expense of 40. So you are left with a profit of 10. Repay that borrowing using this income. So it is application of income and you come to a 0 number. So this is what on case to case one can look at. Third,
carry forward. This excess expenditure is not allowed from assessment year 20 to 23. So up to assessment year 21-22, that past excess expenditure will be allowed, no? Excess application.
So there is I have not completely applied my mind to this, but on first thoughts, there is a Supreme Court decision in the context of
growth education,
which says that law on the date of the assessment year in which set off is asked has to be seen.
Okay.
So the law on the date of in the year of set off already has that you will not get it. So you should not, but I have not seen the language of the amendment. So
will lapse in assessment year 21-22 also it will not be allowed because of this wording used. So excess application.
If you look at how do I spend the money? If I have only 10 layer trust, it could either be from my 15% savings which I have, or from my corpus, or from loans. So loans and corpus, earlier they did not have not blocked. So therefore you are using those corpus and taking advantage of carry forward, which they want to now.
Next is a very small one, that threshold for universities. It is threshold earlier it was for each university and not for one legal person. So one say society may have 5 universities. The threshold was for each university. Now they have given a threshold for a person being assessed under income tax and said that 5 crore is a threshold, but you consider all the education institutions which you have and not independently.
Question.
Yeah.
Whether the specific donations can qualify normal donation or corpus. I think they are normal.
So unless it is an instruction, it is a corpus donation. It's a voluntary.
If it's a specific purpose, unless the principle is blocked, it should be.
Generally, any donation is for advancement of objectives of the charitable institution. But the purpose should be better is to be classified as a corpus donation for this purpose, rather than just saying it for this purpose. Otherwise, every charity has certain objectives and it functions in those objectives only. But it is again a heavily debated issue. I would be more comfortable if you write a corpus donation rather than just writing a specific word. We have already discussed that one is on renovation repairs, which is a very specific one, which we can skip. Second, we have already discussed that now it is cash basis and not mercantile basis. So your earlier accrual principles that and section 43B will not allow. And there is a stray ruling to my mind of Mumbai Tribunal that if something is irretrievably marked, is also earmarked, is also allowed as an expense, those would not hold good. So this is in brief about charitable trust. Yeah, please.
Little louder so that.
Which earlier was after.
Right.
So when they take us to a conclusion that for a particular assessment year, by two different assessment years, income will be taxed in the same way. That is one for which 5 years is completed, and other 5th year itself unspent.
Yes. In the transitionary year, this will happen. Yes.
Sorry?
Can that be?
It is perpetuity.
What is that?
We'll proceed next.
So, updated return, coming to the new concept of updated return. Possibly the last topic, or will I think so. I'll first cover the key changes in ITR and then come to updated return, because this we have time to deal with. Means you have time till December. That's all. So key changes in ITR forms. One change which is there is disclosure of foreign assets applicable to limited taxpayers, more thresholds of 50 lakhs of income, etc. being prescribed. So there was always a dispute on what day the asset has to be seen. If the foreign asset, there is a business being carried on, the accounting year over there may be a calendar year, say Jan to December. We follow April to March. How to when to be disclosed. So this time they have first time specifically provided that you have to look at the calendar year and not the accounting year. So whatever foreign assets were there on 31st December are to be reported in your ITR and not 31st March. Possibly for ease, one may say that even then for a return in July, you have sufficient time of 31st December data being there. Otherwise, specific accounts to be prepared for 31st March may be an issue. Second is the disclosure in the context of capital gains have been increased quite a bit. For example, date of purchase and sale of land and building are to be specifically mentioned. Year-wise details of cost of improvement and land are to be stated. Separate disclosure of cost of acquisition and indexed cost of acquisition. Earlier, it was for long-term only indexed cost of acquisition. Now they also want cost of acquisition to be mentioned. And slum sale, because of the amendment in law last year, they have also provided that you disclose the fair market value and the consideration. This is consequence. The first three disclosures are something new which have come in. Then there is a new schedule which luckily is only for ITR on companies, ITR 6, that details of unincorporated entities, basically AOP, BOI, and really even your partnership under 1932 is not a incorporated entity. It is unincorporated. It is just registered. LLP is an incorporated entity. So if you are a partner in a partnership as well, unless the CBDT instruction says otherwise, it is an unincorporated entity and would be covered you have to cover name of entity, type of the entity. So possibly if there is a drop down on type of entity, we may know what entities they have, unless they have a residuary of other entities. Then PAN of the entity, whether the entity is liable for audit, share of profit in the entity, amount of share of profit, capital balance, whether 92E applies or not. So all these are extensive details which they want to capture in the ITR of the company itself, where it has an investment in an unincorporated entity. Generally, you don't use the word investment. You are a partner, or in association of person, you are a contributor. You don't invest. You don't invest to sell. You do investment possibly in, one may say AIF, which is again a trust structure, and it is unincorporated because you have units of the trust. But I don't think so. They want to cover those. Here, the intention looks to be AOP BOI. One will only know from the instructions whether even an investment in your AIF or REIT, InvIT, which are all in trust form, are also to be disclosed.
No, it's not in Schedule FA. It's a separate schedule.
So unless instruction says otherwise, if you have an investment, you have to even disclosure for an investment. Okay, so this is low on battery. PPT. Okay, so I think so. My laptop also wants me to shut now. So
we have
key changes in ITR.
Charges.
So second is now for residential status in section 6 have been amended couple of times to now provide one is reduced 180 days to 120 days. Now, if you are in a foreign jurisdiction and there is no income, you have income of more than 15 lakhs, but there is no liability to tax in that jurisdiction, you have to pay if you go out for MS. So all those things of section 6 have now been in detail incorporated. Sorry. So all those things are incorporated now in ITR, which one has to capture. On two small things on dividend, that a specific exclusion from dividend income has to be, a specific exclusion of dividend income in the schedule of business income is provided. Otherwise, you had general exclusion for income taxable under house property, capital gain, other sources. Now they are specifically provided for a dividend income exemption separately. And in other sources, you have to now separately report the deemed dividend under 222E. Basically, loans which are treated as dividend are now to be separately reported. We have discussed this at the start, that reporting of interest accrued on PF, to which no exemption is available. There is a separate entry now in the schedule on other sources. There is a new schedule which has come for tax on deferred ESOP taxation, basically. Disclosure for alternate tax regime for individuals, companies, and cooperative societies have been incorporated in their respective ITRs. Secondary adjustment which is to be made under transfer pricing, a disclosure has been incorporated for that as well. And last, disclosure of interest paid on deposit taking NBFCs or systematically important non-deposit taking NBFCs is also incorporated from 43B perspective.
On the third last bullet, that is disclosure of our alternative tax regime opted. Here, though if you would have opted earlier years, say last year for assessment year 21-22, so you need to give the date again in this year also, that what was the date and some acknowledgement number or some number they will be asking, which you need to incorporate here again, that last year what it was opted for. So that's a requirement you need to take care of. Yeah.
But here, where should we put to that amount in exempt income?
Exempt income.
Exempt income, because
Yes, sir.
the age now it is coming, so.
Yes,
they
yes.
may raise the question here.
So you have made an appropriate disclosure that it's an exempt income. Yes.
In case of this foreign assets, the ITR also asked to report the income from that particular asset. How much is the income and where it is reported?
In the case of foreign income.
Foreign assets.
Uh-huh.
So now when we switch to calendar year, that income mismatch will be there.
So income would be yes for that. FA has that income for the calendar year.
Yeah, no, I think his question is, Dipesh's question is, how do we match the income for the quarter period January 21 to January 22 to March 22?
I have a bank interest.
Yes,
So if
in that period.
Bank interest I report for Jan to December, but my taxable interest will be from April to March.
See, again, to the best of my knowledge, the foreign asset schedule only requires you to state the value of asset. Doesn't
Income also. Income.
there is a
Okay.
So
Income,
then
that,
there would be a mismatch.
that mismatch would be there. I agree, Dipesh, to what your question is.
But in your general ITR computation, you don't have a separate line of income from foreign assets. No, agree. I am only saying how would there be a mismatch? Income from other sources only has interest, whether domestic or foreign. There is a FA schedule where you are reporting for a particular period. I don't think so. The CPC should compare both of them. That's all I'm trying to do.
In case the schedule.
Agreed, sir. So, assuming I had made a deposit on 1st April and interest up to December is 10 rupees and up to March is 15 rupees. Just pardon me for numbers. So, in my other sources, I'll show 15 rupees. Here, I'll show 10 rupees. But this 15 rupees would be along with all other interest incomes which I have. So, one-to-one comparison may not be possible.
Their return in foreign country and
This.
Should I show 10 rupees or should I show 50 rupees?
15, that is.
Income has to be computed as per your previous year, which ends on 31st of March.
The problem will arise if you are 26 years plus AIS plus your FA and the schedule is more than what you have reported in the schedule. So then there will be automatic.
Yes. There are chances. Possibly, yes, they may throw. Yeah. I think, Abhitan, if you could still cover up an updating of what we say return. Updated return section 139(8)(a).
Yeah. So updated return is a new concept which has come in. That now over the last 3-4 years, the time period for filing revised return or belated return has been reduced and curtailed to only 9 months of the assessment year. So, say from 31st December 22, you don't have a scope of filing revised return. Say, if there is a mistake or there is a discovery, which generally happens when you are preparing for your next year's return. You discover some mistake which has happened, which creeped in last year, but now you don't have a scope to correct. So now they have come up with a new concept of updated return, where they permit you to update your return, say from end of December, so 1st January 23 for up to 31st March 25. So 2 years, 3 months is the window which is provided to do the updated return. But the catch is there is an additional levy. There is an additional levy of 25% of tax plus interest. If you update in the first year, that is in our example up to 31st March 24, and a levy of 50% of tax plus interest if you update in the second year. So a new mechanism is there where you can update, but comes at a cost. And so if your tax is 10 rupees, interest is 2 rupees. So 12 rupees, 25% of 12 rupees additionally you have to pay. So we would come to 3 rupees, means 15 rupees. So just a comparison, I'll take you to that. So if you see if he does a 143.1, if you discover something of 143.3 is done, I've discovered I'll pay advance tax today along with interest, whatever I have to pay, but I don't update my return. Then what is the risk? I have to face penal consequences of 50% if this is, it is not a bona fide mistake. Then versus if I file an updated return, I'm paying 30% or 33% of additional tax so So it is a comparison based on look at that whether what is the risk of penalty. If the risk of penalty is high, one should file an updated return. If the risk of penalty is low, one may just pay tax with interest and see if it is picked up for scrutiny and how it goes ahead. If there is a case of 200% penalty, say your AIS is updated, what will happen? Generally, one foresees that your AIS is updated and something you have not shown at all. So it would be underreporting, say, of an asset which you are doing for. So 200% penalty may come in. So you may prefer updating the return because it is only a 33% cost. And in year 2, the cost is 78%. So if it is a case of 50% penalty, you will not update it because it is too steep. Might as well pay tax and interest. Even if the penalty is levied, you are not worse off. But if it is again a 200% case, you may update. The fun comes when it is an addition under 68 to 69D because there the tax rate is 60%. And you have to pay 25% of that. So it comes to 75%, that too plus interest. So it may not be a workable solution to file an updated return in that case. So this is the broad way one has to look at updated return. Now just briefly touching on who cannot file. So we have seen one feels if there is a mistake, you can file. It has started, but no forms are. To my mind, our utility is not.
Utility is not
form
there.
has come. Form has come.
2 years. You can.
Yes. For earlier 2 years, that is there in the explanatory memorandum as well, that you can file. Yes. So you can file for AY financial year 1920 and 2021. So AY 2021 and 21-22. You can update. And you have to, one more thing to be noted is you have to pay tax, additional income tax, interest, fees, everything before filing the updated return. Only then you can.
And Abhitan, the worst part is that if that income what you are now offering, if it has a TDS element, you will not get a credit of this TDS element because the design of the form is such a way that it doesn't allow you to claim any TDS. Yeah. That's why I was a little loud.
Yes. So just briefly,
It's very technically, it should not go waste. Let me ask you. It's a credit you should get as per the provisions of this law. But the form is designed in such a way that they are asking you only two things. One is, what is the tax you have paid under section 148, that is asset tax. And second is reduction of your refund, which was there earlier. So either of the two. That's the reason. Yeah.
So just
who cannot file?
Who cannot file? So if you have a return of loss, unless you make it a return of profit by updating, or that is a return of loss for that year, but you file for subsequent years and it is such that it becomes a return of profit in a particular year, then you can file. Otherwise, you cannot update the return of loss. You cannot ask relief basically in updated return. It cannot be a refund return or something to reduce your tax liability. And if a search or survey is done on you, you cannot file updated return for any year. So and it is only one time for any year. In year
All
surveys,
10 years you cannot.
you cannot. No, for any year. On a person to, yes, God knows whether you can file after 5 years or no. One has to examine that. But the section reads, any person against whom proceedings under following sections have been initiated. And there is a separate exclusion where it says, for example, 147 proceedings or black money proceedings, they categorically provide that proceedings are initiated for the relevant assessment years. For search survey, they have not provided that and made two separate provisos with this distinction. So intention is not to cover. I would feel that all earlier years would be covered if search is happening today, but subsequently nothing is there.
According to them, if the search party, according to the department, if you see the provisions that how they have been considered, whether it is 148 or whether it is updated return, if the search party has come to you, in that case, you are a victim itself. You are a culprit first. They have considered whether they find anything, they don't find anything, is a different thing.
Then you are eligible to file 10-year return. No? So free of charge without additional.
Yeah. Yes. That's also a new provision which has been inserted.
Some of the ADI, they have issued notice to the SSC for not giving information of foreign ESOP or anything. So whether such person can go for update return, because it is someone are issued investigation with, not from assessing officer.
Not her.
No, it is not a sir. Only 131 summons is issued by investigation wing. Because I have gone, your assessing officer start proceeding, then only you are proceeding.
Yeah. So
Okay.
it's not a search, so can be covered.
No, search me, even if there are any proceedings, black money proceedings, black money, any other.
Assessing officer.
No, black money proceedings is not by assessing.
Proceeding is just an input.
It is a long one. It is other similar acts.
The particular.
Regarding your so so then they came to know all the who are the legal part. So they will issue all the beneficiaries, including why it was not declared. But what has happened? We have declared some different name. So it has changed two names, and now it is showing differently. So now it has come to so many.
Now, there's a penalty on non-disclosure of information. So penalties of 10 lakh rupees.
10 lakh rupees. Yes, yes.
I think section I was just.
No, I think Dinesh bhai, your question is whether a mere notice which is issued from the investigation wing, investigation will form into any proceedings which have been carried out.
No. I have not captured it completely. I have written black money proceedings or similar acts. There is specific for PMLA where they say a notice has been communicated to you as information. Sorry, clause C. Yeah, where? Clause C. Yeah. So that's anything in the chat. That year. Yes.
But here it talks about the AO has information in respect of such person for or a black money act, and the same has been communicated to him prior to the date of furnishing the return. So, So it is not the, it's not the investigation, it's from the AO.
No, but see, AO will never have under PML.
No, who has
ED
been
will-
communicated, who has
No.
an information in respect of such person for a relevant assessment of his position under the so-and-so law. So the AO would not have
To
under
read it
the-
in context, the officer under that law having and it is communicated to you, the intention is not to allow you. And
that now we are coming out. After this, we have brought to your notice.
This doesn't prohibit additional. I just file say, I will announce 1,000 rupees income. I will give all information. Last 2 years I have forgotten. So I will give. So now I will say, I have disclosed everything.
No, your utility will not allow you to disclose that foreign.
Just we are waiting for you.
Sir, even the time and age today, the decision of Supreme Court we just discussed in the Apex Laboratories. If you are not complying in substance, you are not. With 1,000 rupee, no one will. We can try technically. I doubt that very much. But even then, I don't see, at least in my opinion, a judiciary hearing to a 1,000 rupee with a disclosure of 100 crores of foreign assets.
Also, see, tax says everything is deducted. Only there is a non-disclosure of
But
information. This
he's
is a
trying to
technical
say,
thing.
yeah, he's trying to
Sir,
say,
if it is bona fide, you go on bona fide rather than doing this updated return.
But Bombay Tribunal judgments are there directly. Pramod Kumar judgment is there.
No one is disputing the bona fide. It has happened in a number of cases where there are employees who were abroad. He's given some ESOP or something, and he just one misses reporting that. Joint holders are. Yes.
Like, as a joint holder, I will not disclose.
Yes.
All the holders will not join.
Yes.
So, same officer comes out.
yeah, so here the question is not, Dinesh, but there may not be any undisclosed income to that extent, like the example Abhitan said about ESOP or the joint holder. That may not be, but of course, the 10,000 rupees penalty would be there for non-disclosure of that asset.
Some schemes. When
Yeah, you need to fight for all that. I appreciate. Abhitan, yeah,
I
you
think
can
so.
conclude
Yeah,
your
I
part.
think so. I'm through. Just thank you everyone for a patient hearing. It was a good learning for me.
Yeah, I'm sure everybody would agree that yes, he has covered up in the time allotted to him. Along with the chat box also, he is very savvy, so he could even see the chat boxes and the questions what has been raised by the others. Just to have a little wholesomeness, I would say that certain issues which are relevant for our filing the return of income, which the amendments, though they have not come up right now for 22, but 21, like 194Q. One needs to be careful that yes, that does not, that even provisions of section 40A1A, though the TDS amount or the rate of the TDS is very small or meager, that is 0.1%, but the disallowance of that entire purchases, if the TDS has not been carried out, would be 30%. So that is one area which one needs to be careful about. And of course, the applicability is not very common, is regarding the provision of section 247A, that is the newly virtual digital asset assessment here. 23, sorry, that is 23-24. So yeah, that is not in this year. And one very surprising, which just our office brought to my notice, was the penalty provision of section 272 capital. It has nothing to do with the filing of a return of income. But normally, which even I understood that, for example, if form number 15H, 15G are not filed, 100 rupees per day is the penalty. That has been very quietly, surprisingly increased to rupees 500. But of the deductor.
Director, yeah.
Deductor. So 500 rupees hai per day ka, and not 100 rupees. So the only fortunate part is what they have a habit of last few years, that they just put on 1 0. They have not put a 0. They have deleted 1 and introduced 5. So 50% is that. And one needs to be very careful now while filing the return of income. Kindly take into the kindly consider the 26 AS and thereafter that AIS and the tax information system, what they all have. I was just noticing today when I was just running through our firm's what is it, tax information statement, wherein I found that the fixed deposit or the term deposit was rupees 3.5 crore, which I thought that, oh, the firm has such a big amount. But to my surprise, when I just talked with my partner, and she said that, sir, ये flexi deposit जो करते हैं ना, वो है. So it's just turning these flexi deposits into the term deposit, and which has been captured as a term deposit. So what I'm trying to say is that one need to be careful about all your AIS, and particularly they are trying to capture many information from the GST portal. So whatever you are doing your online purchases, आपने laptop मंगाया, कुछ भी किया, you may not know the vendor. आपका vendor is Amazon. But what is reported in your AIS is the vendor who has sent you this, and so you need to just keep your things ready from your while reconciling. So as Deepesh was saying, for one particular issue, कि आपको reconcile करना पड़ेगा 26 AS, AIS, and this task, this and all this. So the only worry is that how does the department look at it? I appreciate that intention of the department is very good, and we do consider this a bold step. Department is saying that, look, we are giving you this AIS before you file the return of income. You please consider this all, whether you have considered for your computation of income or not. But the unfortunate part is that tomorrow it would be some other officer, or maybe even the GST department would come and say that, look, you please reconcile all your ABCD. And thereafter, let us know what is the violation under GST law, under your income tax law, which today also we all professionals are facing, that when we have to reconcile our 26 AS with our books of accounts and with our GST return. Because all the three has a different definition of the word turnover or a receipt. But they would not want to understand this problem. They want us to understand all this and bring it to them in a more platter form, that, look, this is what you are asking for.